S&P rallies on Friday, taking out about a 3-week high, filling that gap. We're going to talk about why this happened, why Fed member Bostic's statement is so important, the confidence in investment banks that we will only see a 25 basis point rate hike in February. For stock updates on the ever-changing trends, make sure you subscribe to this channel. What we go over here is extremely timely. If you like this content, smash the like button. First, we're going to go over what happened on Friday. Second, we're going to go through where we see the index going. Third, we're going to go through specific ideas that look very attractive for next week, both on the long and short side. Now, to start, we had non-farm payrolls. Non-farm payrolls came in higher than expected. Now, we saw a decrease in the previous month, but the unemployment rate of 3.5% is still very robust. Average hourly earnings month over month, we did see a decline, which does show us a sign that we're seeing some relief in the labor market, very little. Average hourly earnings year over year are down. Based upon this, we gapped up, tries to rally, and then fails. Now, by 10 o'clock, we have the ISM data. That data showed a contraction the first time in more than 2.5 years. We had weakening demand, and the pace increase in prices paid by businesses slowed. The significance of this cannot be understated. ISM manufacturing PMI dropped below 50. 50 shows signs of contraction. We have not seen this since May 2020. Now, that 10 a.m. gave us a little bit of a push, got right back to the opening price of the first 5-minute bar of the index, pulls back a little bit, and then finally breaks through, forms a base right off the open, comes back, retests, and then goes. So we rallied off of the ISM data to start this move. This is important because ISM, manufacturing, non-manufacturing, PMI, that contraction showed that the actual plants and warehouses and facilities are starting to slow down. If they slow down, then that means the labor market is starting to soften. This is what was confusing to a lot of people that really don't dig into the macro. What was confusing, now if you didn't understand economic data and the macro, you wouldn't understand why Bostic came out and said the labor market continues to ease. If the labor market continues to ease, that's a very interesting statement considering that we haven't seen that. But the ISM data is pointing to that exact action happening. We continue to hold support here and then break out of that little high on another push. Now, we got more data. We had more data as the day went on with China. China is in talks with Pfizer for a generic COVID drug. The significance of this shows that China is committed to reopening. That solves one major problem that could help inflation come down. With the reopening of China, global supply chain pressure is decreasing. As supply increases, pricing pressure will decrease. One of the things I want everyone to look at when they're looking at this chart, and this is just newyorkfed.org, understand that you are looking at a standard deviation chart, not a percentage chart. So the zero line is the average standard deviation of pressure of global supply. So even though you're still not at zero, you can see how we're coming down and look at the contributors to how we're coming down. The largest contributing factors to supply chain pressure were courier delivery times, Taiwanese inventories, but these were more than offset by smaller negative contributions over a larger set of factors. Recent movements suggest that developments in Asia are slowing down the index return to normal historic. China opens, supply chain gets easier, inflation drops, equity prices go up, Fed has to do less. That is why JP Morgan made the comment that they did. It's why Goldman made the comment that they did. You have the ISM data, you have China, and you have the jobless claims data, and you have the non-farm payrolls data. Please share this video today. I purposely do not run ads. The reason I want it shown is I want people to actually understand what is going on. A lot of people are looking for the past to continue, and that's not going to be the case. And we're going to get into that and some stock ideas now. But if you could share it, it would definitely help people at least grasp these concepts. You can see your level in here, right on the SPY, how you're rejecting, how you're bouncing around, what level of support, what level is resistance. Now, if we look at this, all we see is a pretty clear downtrend. If we just anchor a VWAP to the top of the beginning of 2022, you can see how the volume weighted average price for the entire year has just been respected. We've had a couple bumps where we've gotten over it, and then these are standard deviations of that. And you can see sometimes we actually respond to those standard deviations as support levels, which is right where you're in. Now, I am constantly looking for pattern. One of the things I noticed about this chart is you're unable to stay longer under this standard deviation. So in other words, you're unable to stay lower than this standard deviation for longer periods of time. Let me explain what I mean by that. You take into account this section right here, you can see how long we were under that standard deviation. Now, by looking at this, you can see how the time frame under the standard deviation is getting less and less. Does this mean that you can't roll back down? No, of course not. It's one data point, but it's worth pointing out. Now we have this close, and I'm not going to get too excited about what we're seeing here until we get more of a move off of that level. You are wedged right in here, and we gap filled. And we gap filled two major gaps. Now, if we focus on that index and then look at value versus growth, we're seeing a very specific pattern develop. We're starting to see a little W form down here, a double bottom on value versus growth, and we're starting to see value actually push higher. If you look at performance last year, the one common theme was active management outperformed the indexes by one of the largest margins in a decade. This is value investing. You can see how you're trying to flip a 15-year DTL or downward trend line. So now we know that it's maybe slowing. We know that the S&P seems to be holding, at least for now. And we know that value is outperforming growth historically over the past 5 years. And now it looks like we're going to flip a decade-long DTL. What areas do we look at? Start by drilling into value names. The majority of stocks in the Dow are value names. And what we're seeing is this pattern of death crosses flipping to golden crosses, which is, in my case, the 55 flipping the 200. This is significant. This had every opportunity to break. A matter of fact, it actually gave us a signal that it may break by closing below the 55 for the first time since October. Every signal that you use, they have about 3 to 5 days to correct, and if they don't correct by then, it's pretty much it. Now, so we look at the Dow and we see how the Dow is forming that golden cross. Then we look at the MACD, which we use solely for giving us sentiment on what is going on in the market. And we can start seeing that we're flatlining and looking like we may actually cross up and lead to a push. Then we start looking for sectors that have a golden cross after a death cross that may have the same exact pattern that the Dow has. Index, sector, stock. That's going to be the theme for 2023. This is one that we have in the news. To get a copy of the newsletter, there is a link in description. Our technical pivot area was the 197. Since then, this industrial has just constantly been moving higher, no matter what the market is doing. This is industrials divided by tech on a weekly basis. You can see the outperformance of industrials versus the tech sector and how we just formed a double bottom by undercutting the low and then making a higher high. If we go through history, we can find another period in time where this exact pattern happened before, and that is in 2000 to 2001. We have the undercut, the rally, and then the subsequent close over confirming the double bottom, which then leads to a multi-year run. Here's Boeing on the weekly. Look at the trajectory of the 10-week moving average. The last time we had a moving average that moved that fast was back here in 2016. If we remember 2016, that was another great year for active investors. 2023 is going to be a stock picker's market, period. You can see very similar patterns where the MACD is flipping the zero line, and we are flipping that zero line here again. This is financials versus tech. You can clearly see that breakout. The last time we had such a breakout was during the great financial crisis, where we consolidated and then had a multi-year run of financials outperforming technology names. You can see the same level of outperformance in 2000, flipping in about 01, and then a multi-year run. We look at names like JP Morgan, we see them sitting right on major resistance levels, and these are beautiful, where you test as if you're going to break, comes back down, holds that 10-week moving average, and then tries to break out. But before we break out, if you notice that close, the close on JP Morgan is substantial. We haven't been here for about a year. Basically, it's called 9 months. Your MACD is back over your zero line, which is exactly what happened in 2000, 2020, and 2016, which were both multi-year runs for JP Morgan. Now, there's an important distinction to be made here about what stocks to be looking for. This is the NASDAQ in relation to the S&P. And you can see since about the peak of November, just a significant underperformance. Why the S&P is holding and the Dow is having golden crosses, the NASDAQ continues to be weak. Now, if we look at 2022 and we take a look at the technology index in white versus the S&P that is in green, we can see the significant underperformance for the past year. Bank of America's comments this week echo exactly what I'm saying. And Fourth quarter 2022, all tech as a percentage of U.S. equity markets was 40% versus 19% in emerging markets, 13% in Japan, 7% in Europe. They go on to say big 8 stocks already down 30 versus 21% of the US market. Yet investor rotation out of the tech sector has yet to begin. I covered this concept in 2 newsletters that went out this week called They Come for the Generals Last. And it's exactly what happened to us in 2001 and 2002 as well. By focusing on death crosses and golden crosses, it's going to put you in the right sector. I'm going to say it one more time. Index sector stock is how you should be viewing the market in 2023. You're looking for alpha. The days of just chasing beta are far, far behind us. You see these little crosses, and you can see these in a lot of other names. Look at how that MACD is holding right above that 0 line and has been since November. All we're doing is just constantly grinding higher. If you look at the weekly chart, you can see that this week we have cleared major resistance. For confirmation, obviously, we're going to want that higher high, but we can see the weekly MACD is crossing back above the 0 line, which we were below since January 2022. We can see how we responded in the past to that MACD crossing in 2020 and 2016. We can see how Pulte is setting up. We can see how Linear is setting up exactly the same way. If we look at names like Comcast, we're seeing these little setups, seeing these little MACD flips. If we look at names like this on a weekly basis, you're seeing these undercuts forming double bottoms after multi-year corrections. Perfect ski slope. Now we're seeing it reverse and possibly getting back over that 0 line. And we look at this close, and it certainly looks like a breakout to me. Being a stock picker's market, you're going to want to see drivers of very specific companies. So you're going to see a lot of binary events this year. Those binaries are going to be companies that are having good products, such as MDGL, having really good data on their clinical trials of their main drug. And we're starting to see these little patterns develop where you're consolidating after a breakout, and then you're starting to hold these levels, and then you're going to push, right? That's kind of the plan here. If we look at this, since it broke out on the weekly chart, we can see that all we're doing is hanging out at the top end of this long green bar, which is exactly what we want to see. Really quick trick is to put Fibonacci levels on the breakout bars and then see if you even get to that 50% level, which you were unable to do here. We're starting to see more money flow into brand names. Starbucks is a great example. Consolidation breaks out. Now you're into this gap, and you have very little that you really have to worry about in here before we're back up and retesting this level, that 116, 117 level. So these types of names I would be focused on. The beaten down brand names, take a look at Nike and how you're flipping these levels, setting up for a golden cross after your death cross back here. Look at the consolidation and push of volume since the beginning of the year in names like T-Mobile. Having that 200 and respecting that 200-day moving average. You have a buyer there, obviously. And what we're going to see is we're going to see if we can finally push and break out and maybe get back up into this upper channel that's right there. IDXX, huge volume, death cross, golden cross. Names like this, after they consolidate and break out, which this is obviously setting up to do, get into these gaps and then have the potential to rally to the breakout point or breakdown point. The potential magnitude of a move like this can be seen forming that W with the undercut, forming a double bottom right on the 200-week moving average and flipping the 55-week moving average. Just like 2000, 2002, we will see stocks that will just continually grind down. Most of those names are going to be in the technology space. SPLK is very interesting because on Friday we were absolutely unable to rally over the opening, which the majority of stocks did. Instead, we retested at 55 SMA for the first time since closing above it. So we're going to watch how we respond to this level and seeing if we're going to break here, because if we break down here, we have the potential of that channel. You can see on a weekly, very clear how they just keep walking us down. To join the Alpha Chasers community, there is a link up here in the top right. Simply click the link and you will be added to the wait list. I read every single comment and respond to every single comment. It just takes me a little bit of time. Please comment on this video. The purpose of today's video was to go through why things are happening so that you can actually understand the nuances. One of the things I've been trying to get people to really grasp is the way you study technical analysis in 2020 is the way you should be approaching macro and fundamental analysis in 2023. It is the active manager that is going to win, that is out there chasing alpha. It is not going to be the person that is just looking for the next high beta stock. Should be an exciting week. We have CPI. Have a great day, everyone. Remember, price pays. Everything else is conversation.